The number of Americans filing for unemployment benefits unexpectedly rose last week. This surge in jobless claims has rattled financial markets and raised concerns about the health of the U.S. economy. Economists closely watch this data point as a leading indicator of labor market conditions. The sudden increase after months of steady decline suggests potential cracks in the labor market's foundation.
The recent release of these figures sent shockwaves through Wall Street. Market analysts accustomed to more positive economic news are now scrambling to reassess their forecasts. The unexpected jump in claims has fueled speculation that the Federal Reserve's aggressive interest rate hikes may be having a more pronounced impact on the labor market than previously anticipated.
The data release comes at a critical time for the U.S. economy. Inflation, although showing signs of cooling, remains stubbornly high. The Federal Reserve has been raising interest rates to combat inflation, but the effectiveness of these measures in engineering a soft landing for the economy is still uncertain. The latest jobless claims figures have injected a fresh dose of uncertainty into an already complex economic landscape.
This uptick in unemployment claims, if sustained in the coming weeks, could signal a turning point in the labor market. It could indicate that the robust job growth experienced in recent months may be losing steam. A weakening labor market could have ripple effects throughout the economy, potentially impacting consumer spending and overall economic growth.
Bond yields, particularly on the 2-year Treasury note, have dropped sharply in response to the unexpected rise in unemployment claims. This decline in yields reflects growing investor concern about a potential economic slowdown and increased demand for safe haven assets like government bonds. The bond market, often seen as a leading indicator of economic sentiment, is now flashing warning signs.
The 2-year Treasury yield, which is highly sensitive to changes in interest rate expectations, has experienced a particularly steep decline. This drop suggests that investors are now anticipating that the Federal Reserve may need to reverse course and start cutting interest rates sooner than previously anticipated to support a faltering economy.
The bond market's reaction highlights the delicate balancing act faced by the Federal Reserve. On the one hand, the central bank is tasked with taming inflation, which necessitates keeping interest rates elevated. On the other hand, raising rates too aggressively risks pushing the economy into a recession. The recent volatility in the bond market underscores the uncertainty surrounding the economic outlook. Investors are grappling with conflicting signals, trying to decipher whether the rise in unemployment claims is a temporary blip or a harbinger of a more pronounced economic downturn.
In light of the recent economic data, the Treasury Secretary has publicly suggested that the Federal Reserve should consider cutting interest rates. The decline in bond yields, particularly the 2-year Treasury yield, indicates that financial markets are pricing in a recession, and that the Federal Reserve should act preemptively to avert an economic downturn.
The Secretary's remarks have ignited a debate about the appropriate course of monetary policy. Some economists agree that the Federal Reserve should heed the bond market's signals and begin easing monetary policy. They argue that the risks of inaction, namely a severe recession, outweigh the risks of cutting rates too soon.
However, others caution against reading too much into short-term market fluctuations. They argue that the Federal Reserve should remain focused on its primary mandate of controlling inflation, which remains stubbornly high. They believe that premature rate cuts could reignite inflationary pressures, undermining the central bank's credibility.
The Treasury Secretary's public call for rate cuts highlights the potential for tension between the executive branch and the Federal Reserve, which is an independent entity. While the Treasury Secretary's views carry weight, the Federal Reserve ultimately makes its own decisions based on its assessment of the economic data.
Central banks often face a tricky balancing act. They need to manage inflation while also supporting economic growth. It's not an easy task, and sometimes the tools they have can seem blunt.
Exactly. When inflation is high, raising interest rates can help cool things down, but it can also slow economic growth. It's a delicate dance.
When we look back at history, we see that key economic indicators like GDP growth, unemployment rates, and inflation have always played crucial roles in shaping policy decisions. Understanding these indicators helps us make sense of current economic conditions.
These indicators provide a snapshot of the economy's health and guide policymakers in their decisions. They are essential for predicting future trends and potential challenges.
Sometimes, despite the best intentions, policy errors occur. These can lead to economic tensions and unintended consequences. It's important to learn from past mistakes to avoid repeating them.
Absolutely. Policy errors can have far-reaching effects, and understanding their causes is key to preventing future issues. It's a complex and often challenging task.
Moving forward, it's crucial that policymakers remain data-dependent. By closely monitoring economic data, they can make informed decisions that balance growth and stability.
Yes, relying on accurate and timely data allows for more responsive and effective policy measures. It's all about staying informed and adaptable.